Thank you.
I've already opened it up, sir.
Okay, that's correct.
No, I think we can start now. I think we have enough participants, and it's 2:33 now, so I think we can start now. And hi everyone. I hope you can hear me loud and clear. The topic for today would be capital gains tax. Now, if you can see my screen, can you please indicate by saying we can see? Great, thank you very much. So the first things to note.
Yeah, I think you're ready to start. Follow Jimmy.
Yes, I am.
Okay, so I need to. Where is that, Sarah? Sarah, do you have Follow Jimmy's profile? Can you send it?
Yes, I have it. Let me send it to you, sir.
Okay. Just wait a sec, I beg. Please, can you send it to my WhatsApp?
Yes, I will do that right away.
Okay. Okay, Follow Jimmy, will you be able to just send it to our WhatsApp group?
Yeah, Prof,
I'll
I've
send
shared
it to you now.
the profile.
I'll send it to
Check your
you.
WhatsApp, you see it shortly.
Okay, I've seen
sent
it. I've seen it
Okay.
from okay.
Okay.
Thank you, ladies and gentlemen, and members of the bar. We have today's lecture to be delivered by Follow Jimmy Akinla. And Follow Jimmy's profile reads that Follow Jimmy is a tax dispute lawyer with PwC London. Prior to joining the London office, he led the tax controversy and dispute resolution team in PwC Nigeria and the West Africa market area. Follow Jimmy is a qualified lawyer in Nigeria and trained in the law firm of Tayo Yetibo LP, then Tayo Oyetibo and Co. So today, Follow Jimmy, you can see he's a very experienced tax lawyer with experience in Nigeria and UK, and currently working with PwC, which is one of the big four. So we'll have a very good hand here. And Follow Jimmy has been working with the NBA ICLE. So Follow Jimmy will be speaking on taxation, on capital gain tax today, and it's a very important area of the law. So the floor is open to Follow Jimmy. Thank you.
Thank you very much, Jude. Thank you, Doctor. And hi again, everyone. It's nice to be here. And I think we've lost a few minutes because we're supposed to start at 2, but we moved to 2:30. I think we can go. The session will take roughly about 1 hour, then see if we can have a couple of questions. Again, I will try not to, I'll try to make it light, being that today is Friday and then we've had like a whole week of these classes. So the first thing to note is that capital gains tax does not get a lot of attention from people. and there are good reasons why. And I know that for sure, because if I take a poll on this call, if I take a poll and say, how many people have paid capital gains tax before? Can you please indicate by raising up your hands? I know that the response will be less than 1%, right? And that's not peculiar to Nigeria. It's like that generally when we look at the trends across the world. When we also look at tax disputes, when we look at the law report, right? When you compare capital gains tax with other types of taxes, VAT in particular, also CIT, you have like a 70-to-1 ratio. So if you have, you first find 70 VAT disputes or 70 CIT disputes before you find one dispute in capital gains tax. And when I look at other jurisdictions, and I'll use the UK as an example. In the UK here, for the year 2021, 2022, the capital gains tax, right, was paid by only people who had capital gains of £5 million and above. And that figure, those number of people represent less than 1% of the entire capital gains tax population. So it's a tax, I'll call it a niche tax, because a lot of people say it's a tax for rich people, right? But that's the reality of it. But why do we have it like that in Nigeria? If you look at Nigeria specifically, why is the compliance so low? Number one, people think it's a tax for the rich. So you're first thinking, oh, I don't have an aircraft to sell, because capital gains tax is a tax on gains, right? So breaking it down, right? If I buy an asset, a capital asset, let's say a ship or an aircraft for 100, right? And I set it down the years for 200. The gain on that tax is 100. So that's the tax base. So many people just feel like, oh, it's a tax for the rich. I don't have such huge capital assets to pay tax, so why bother? Another reason may be because of the reliefs. So if you look at the Capital Gains Tax Act, until last year, I think, there was no CGT on shares, right? Even now that there's CGT on shares, there are exceptions, there are major exceptions. So at the end of the day, you find that it's only a fraction of the entire capital market that will be subject to capital gains tax. The third reason is the tax authorities. So FIRS is, in their wisdom, and rightly so, will be chasing tax sums using their resources efficiently. So there's no point in FIRS dedicating so much resources on chasing capital gains when the receipt is low. You rather expend their energies, resources, and when they think you can get the most taxes, biggest taxes across. So these are some of the reasons why we see that in reality, in practice, capital gains tax doesn't really get the attention it gets. But recent changes due to the Finance Act has introduced shares, as I said, and also digital assets. We'll see more of that in the course of this class as taxable or chargeable assets under this act. So we can only hope to say, okay, maybe by virtue of these new amendments, there will be renewed focus on the tax, because FIRS would expect to get more from the tax going forward. Now I flip through the slides. Can we see the slides? So the learning outcome to this. So at the end of the session, we'll be able to understand the legal basis and some of the fundamental principles of capital gains taxes. We'll look at administration of capital gains tax. It's a tax it's on the concurrent list. So we'll see that both the federal and states have competence to legislate and enforce capital gains taxes. We'll look at recent trends, especially with respect to new amendments in the past, the most recent Finance Act 2022 as well, 2021. They will look at specific items like capital gains tax on shares, because it's a big thing. It's the biggest changes so far in a couple of years, and disposals. Now, this is the content. I won't bore you much with this, only to say two things on this slide. Number one is there are case studies at the end of the slides. I don't think we'll go into the case study. If there's time, we do a couple, one or two, but you get the slides, so you can have a look at the case studies, the questions and the answers there for your benefits. Second thing to say is, in the course of this 1 hour plus, I'll be asking questions just to make it interactive. And if you know the answers, please put them on the chat group. They are right answers, so they're not text questions. So first point, introduction to capital gains tax. So the tax was introduced in Nigeria in 1967. Now, some commentators say that the federal government introduced this tax to give them revenue to prosecute the Civil War. So if you are students of history, you know that the Civil War was around 67, I think, to 70. And that's when the tax was introduced. At the time, it was at a 20% rate. So the rate of capital gains tax in 67, when the act was introduced, was 20%. Now, the principal legislation, there's only one legislation, there's no subsidiary for the act, to the best of my knowledge. So it's the Capital Gains Tax Act. This act has gone through a number of amendments, mostly during the military era. So we've had a couple of finance decrees that have amended the act over time. And it's interesting to note that when the act was first introduced, there was a capital gains tax on shares in different categories. But those were removed. I think in 1972 it was added back. 1998 it was removed, but we'll talk more about that later. Now, currently the rate of the tax is 10%, and the 10% is on charitable gains. We'll talk briefly on how you can compute charitable gains. When I started, I said that when you buy an asset for 100 and you sell for 100, your gain is 100, right? So you're supposed to pay tax on that 100, but there are also allowances you can claim, so that 100 reduces somewhat for your capital gains tax. It's also important to note this rate, 10%. Now, when you look at other taxes, other direct taxes, e.g., CIT, personal income taxes, capital gains tax is the lowest, if I may say. So, for example, you have the PIT bands. PIT bands, the lowest band, I think, is 7%, and it goes all the way to, and the next band is 11, all the way to, I think, 24%. Now, if you look at those bands, capital gains tax is very close to the bottom, right? When you compare with companies income tax, CIT, which is 30%, it shows you that this is one of the lowest, and this gives room for planning purposes. Now, if you're familiar with private equity, for example, PE funds, there's a concept called carried interest. So carried interest is the amount that fund managers make on the funds. And this is huge in practice. These amounts can run up to hundreds and tens of billions of dollars or pounds, if you look at the PE market as a whole. So the argument in those cases is, oh, these gains we are making, they are capital gains, right? So they should be taxed at a lower rate. And most places around the world, capital gains tax is lower than CIT, PIT. So for planning purposes, CGT, capital gains tax, is very useful if you know your way around the rules. Most businesses will try to say, oh, we've made a gain, or this portion of our profits is a gain, just to be able to enjoy a reduced tax rate. Because if you move it to the CIT, it will be taxed at a higher profit. So we'll talk more on that too as we go ahead. As I've said before, it's a gain on capital gains, right? And the trigger point for this tax is a disposal of assets. So when an asset has been disposed, right, is when capital gains tax is triggered. So just note that. Now, historically, and even up to date, if you look at a number of cases on capital gains tax have to do with the dispute in question will usually be whether the income received is income from trading or capital income, right? When a business is functioning day-to-day business, I'll use an example. Let's say a car manufacturer or a car dealer that buys and sells cars. Now, what he does on a daily basis is buying and selling cars. And that's what is contained in his P&L, right? By virtue of that, you can tell quickly that whatever profit he makes is of a trading nature, right? So that example quickly tells us that this tax is not capital gains because of a trading nature. Whereas if the same dealer has capital assets in his building, for example, he has like a machine that uses to wash the cars, for example, that can be classified as a capital gain. So let's know the distinction between a business of a trading nature and an investment of a capital asset nature. Finally, to prevent double taxation, the law in its wisdom has excluded capital gains from CIT. So if there is a gain that is subject to capital gains, it is automatically exempt from CIT. Otherwise, there'll be an incident of double taxation, which the law frowns at. Now look at some specific terms in capital gains tax. And these are what I'll call terms of art, technical terms that that sort of add color or define the nature of capital gains tax. The first is capital sum. When you read the acts, this term, you find this term, capital sum. Essentially, it means consideration. So when you're computing your capital gains, right, this is the base, this is where you start from. You take the capital sum, you deduct your expenses, costs, and any allowables before you now apply the tax to that base. Tangible assets. Not all tangible assets, really, when you look at the act, is defined as all property, right? But then there's a hierarchy of properties in the act. We'll go into further detail on that. But tangible assets, really, in summary, is all forms of property, including foreign currency, whether situated in Nigeria or not. Now, when I see foreign currency, it tells me that when I buy and sell foreign currency and I make a profit, then I should automatically pay capital gains tax, right? That's what it means. But when there's no capital gains tax on Naira because it's a local currency. But once you trade in foreign currencies, the question is, are you supposed to pay capital gains tax on it? So this is my first question. I'll use the colloquial term, an aboki that sells dollars or changes dollars for you. When he makes a profit on sale or purchase or buying and selling of dollars or pounds, is he subject to capital gains tax, or is the profit he makes one of a trading nature so that he should be taxed under CIT? But if you know the answer, just put it in the box. I'll come back to it. Another term to note are incorporeal properties. Now, the Capital Gains Tax Act, and a chargeable asset would include things like patents, goodwill, franchise, trademarks, etc. So it goes against the grain where people think chargeable gains are only imposed on tangible assets like aircrafts, ship, etc. No, if you look at the trade of Capital Gains Tax Act in Nigeria, you will see that there's a focus on intangible assets. And we'll talk more on that as we go ahead. Options 2 is another form of intangible, but it's an asset that is subject to capital gains. Now, something to note is location of assets. There's a part of the Capital Gains Tax Act that defines different locations of assets. Now, why is it important? This is important because it tells you where an asset is located is important to the place of taxation of that asset. For example, with respect to land, land is subject to, it's the location of that land, of course, is where it's situated. Movable property, where it's situated. Shares, place of registration. So this part of the Capital Gains Tax Act just provides guidance, right, on where an asset is located for the purposes of CGT. Now, who administers this tax? As I said at the introduction, the tax is on the concurrent list, right? So that means both the federal government, that's FRS, and state governments, LIRS, OGIRS, etc., have the competence to enforce these taxes. Now, by virtue of the principle of covering the field, because we have a Capital Gains Tax Act already, many states just sort of abide by it because legislating on anything different from CGTA would be null and void to the extent of inconsistency. So the good thing to note is we have a Capital Gains Tax Act. Both the states and federal government can enforce it, can apply it, right? Now, the second question I have is this. If we say FIRS is responsible for enforcing the taxes of of companies with respect to capital gains tax, and states are responsible for enforcing the capital gains tax on individuals, then who is responsible for enforcing the capital gains tax of individuals in the federal capital territory? That's the second question. I think the answer is easy, but just to get you thinking, it's a tax that both levels of government or arms of government, levels of government, I beg your pardon, have powers to administer. With respect to filings, right, the Act creates a window where taxpayers can do biannual filings. So there are two specific dates. 30 June and 31st of December. Recently, the FIRS released some guidance to provide more information on how these dates would apply. So for example, if you have a charitable gain between 1st of December and the 31st of May, right, your compliance date should be 30th of June. And it follows, right, any charitable assets or any charitable gains between 1st of June and 30th of November, your compliance date is 31st of December. And any charitable assets, right, or charitable gains that you had prior to the Finance Act of 2021 will be filed, or 2020, I beg your pardon, which should have been filed on 30th June 2021. Otherwise, you're in default. There are certain exemptions for capital gains made by trusts, but that's not really relevant for this conversation. So the important thing to note here is FRS can enforce it, state revenues can enforce it. And going back to my question, FCTIRS would be the tax authority responsible for enforcing capital gains tax on individuals in the Federal Capital Territory. And if there are any questions, please feel free to put them in the chat room. We'll try to answer as many as we can at the end. If not, I'll see if we can collect the questions from the Secretariat, then respond to people individually. So some of the specific provisions of Capital Gains Tax Act. Now, as said before, in the Act, Section 3 specifically defines what are chargeable assets, right? Essentially, all forms of property created by the person disposing it. So all types of property can be chargeable assets, right? But one interesting thing I found just by studying the Act is that there's a lot of emphasis on intangibles. And I'll tell you why. When you look at the definition, the first line says options, debts, incorporeal property. They are all intangibles, right? The second line talks about currency, right, other than Naira, right? And the third line talks of any form of property. So it tells us quickly that the focus really on capital gains are intangibles. And then when we kind of appreciate that, it now makes sense that the federal government recently introduced digital assets. So things like cryptocurrencies and tokens are chargeable assets now under our Capital Gains Tax Act. We don't know how much that would yield in practice, but it shows you the trend that when you look at the Capital Gains Tax as a whole, the focus really is on taxing intangible assets. And that's not to say that the concrete assets, tangibles like aircraft, ships, planes are not chargeable. It just seems very glaring that the intention of the Act is to focus on intangibles. So another thing I found interesting with respect to the Act is disposal of assets, right? So I mentioned at the beginning that the trigger point for capital gains is a disposal, right? There's no tax if there's no disposal. That's a general rule, right? So the Act says there's a disposal of assets where a capital sum, remember, that means consideration, is derived from a sale, lease, transfer, assignment, compulsory acquisition, or any other disposition of assets, whether or not an asset has been acquired by the person paying the sum. So in essence, the general rule is that for chargeable tax to kick in, or capital gains tax to kick in, there must have been a disposal of assets. However, there are exemptions to that rule. One of the exemptions is compulsory acquisition. So for example, you have a piece of land in Lekki or wherever, and the state government comes and acquires the land compulsorily because they have the power to do so, and they pay you a sum for that, right? Though that is, though the owner of the land would have received this capital sum by way of compensation, but because it wasn't a voluntary disposition, right? That gain or what you've received as compensation is exempt from capital gains tax. Now that does not jump to you immediately you read the Act, but if further analysis of the Act tells you that such payments received by way of compulsory acquisition are exempt from capital gains tax. So again, the important thing to note on this slide, right, is the trigger point is a disposal, right? And when a disposal, a capital sum is received, and whoever received capital sum whoever is paying the capital sum need not receive a property back. Now, interestingly, the Act also defines a second category of transactions that are subject to capital gains tax. Now, these transactions do not have anything to do with disposals, but they are sui generis in the sense that the Act defines them as chargeable events, right? So note two things. Number one, trigger point is disposal of assets. In that disposal, there are exemptions. One of those exemptions are compulsory acquisition of land. When you receive a capital sum for that, you are exempt because, again, your disposal was not voluntary. Now, the exception to the broad rule, umbrella rule, is that there are other categories of chargeable events that are not disposals. And what are they? Compensation for loss of office or loss of employment. So, for example, there's a downturn and an employer has cause to pay an employee a lump sum to leave because their company is downsizing. The capital sum received by the employee is subject to capital gains tax at 10%, right? Similar point, a capital sum received under a policy of insurance for damages, that sum is subject to capital gains tax. The third category, which I find very interesting because I've actually used this, I've relied on this provision before when dealing with one of the state revenue authorities. A sum received in return for forfeiture or surrender of rights or from exercising rights. Now, what happened in this case? There was this company in Nigeria a couple of years ago. They still operated. They had a major restructuring, right? And that restructuring required them to sort of move employees from one entity to the other, still within the same group. Now, in the course of the movement of the employees, the employer withdrew contracts of employment, right? And issued new contracts of employment by virtue of moving people around. Now, under the previous employment, under the previous employment contracts, those employees had to give up some rights, right? Because the company was downsizing. They didn't want to lay off everyone. So instead of laying off, let's move people around, reduce some of your benefits, but the whole intention is to keep people, right? So the company also paid huge sums just to compensate people for moving them around or for distorting their contractual, their employment contracts. So LRS was the authority. LRS came and said this sum is subject to the huge sum is subject to Personal Income Tax Act, PIT. Now, remember I said before, right, that for planning purposes, because CGT is lower, right, if you are very well attuned to the law, you can sort of find a way of arguing a lower rate for your clients. So we relied on this provision to say, oh, because the employees surrendered some of their rights under the previous contract, right, then this capital sum they received, right, was a forfeiture or surrender of their rights under this act. Therefore, these should be chargeable under the capital gains and not PIT. Now, if they are subjected the tax to PIT, right, those persons will have paid taxes at the rate of 24%. Whereas because we successfully argued with revenue that there was a surrender of rights in this case, then the revenue eventually agreed with us. It wasn't automatic, there was back and forth, but eventually agreed with us when we made it clear to them that these particular employees, they actually forfeited or surrendered some of the rights they had on the old contract, under the old contract. So again, the trick is, the thing to note is get familiar with the laws, right? And there's a lot of opportunities with the capital gains tax because many of the provisions have not been tested in court. And that's what interests me as a lawyer. A tax dispute lawyer, when you see a law that has not really been litigated on, it tells you that there are lots and loads of opportunities to actually set the law or set precedents by virtue of the cases we take to courts on those what I'll call greenfield or virgin acts. So again, things to note on this slide. Again, disposal of assets. Capital Gains Tax Act also makes specific reference to the tax or chargeability of ships and aircraft. And this makes sense because some of the biggest assets, right, that people would sell that would yield the biggest revenue for the government are things like ships, aircrafts. So if you have a ship in Nigeria that's used in international traffic, right, the act imposes a tax on the disposal or the chargeable gain, right? As long as the owner is in Nigeria, wherever the ship is. So, for example, if a taxpayer has a ship or an aircraft, right, that is involved in international trade, international traffic, regardless of where that asset is sold, as long as the owner of that asset is resident in Nigeria, that asset would attract capital gains tax in Nigeria. On the other hand, when there's an asset like that, a ship and aircraft that's not used in international traffic, right, there's tax on it, right, irrespective of where the owner is resident. So if the owner is resident outside Nigeria, as long as there's a sale in Nigeria, then the tax takes place in Nigeria. Now, what about shares? Now, if you remember at the beginning, I said when the Act was introduced in 1967, not all shares were subject to taxes. It was only a small category of companies that met certain criteria that their shares were subject to taxes. That was the state of the law in 67. Fast forward to 1972 or 1978. The law was amended to introduce capital gains tax on shares. Following on that, because of the government's desire to sort of stimulate the capital market, in 1998 there was a suspension on capital gains. There's a suspension of tax on sale of shares, but that has been reintroduced by the Finance Act of 2021. Now, the general rule is all shares, all proceeds from sale of shares are subject to CGT at the rate of 10%. However, there are exceptions, right, or the exclusions. So if you sell, for your shares to be subject to capital gains tax, right, the proceeds, if the proceeds are not, so there are three opt-outs, right? So general rule, shares are subject to tax. However, shares will be exempt from tax under three separate categories. One, if the proceeds are reinvested in any Nigerian company or in the same company, right, then those shares will be exempt from tax. If the disposal proceeds are less than 100 million naira, no tax. If the shares are transferred between an approved borrower and lender under the regulated securities lending transaction, no tax. So whilst on one hand, it says, oh, taxes are applied on sale of shares, right? That's not the end of story. There's more, right? Those shares or those proceeds will be exempt where they are not reinvested, they are less than 100 million, and their shares with respect to the regulated securities lending transactions. So, you know, when I look at this provision, I'm thinking, is the government paying lip service? If there's going to be a taxation on shares, then why not just leave it open if you are really interested on raising revenue from shares? But on the other hand, you can also understand the sensitivities, right, on imposing taxes generally on shares, because I mean, shares again will be subject to withholding tax, etc. So I guess, I mean, there's a fine balance that the government needs to meet in that regard. Now, other provisions in the Act. And these are just generally powers of administration. So things like transfer pricing. I know there was a transfer pricing class on Thursday or Tuesday. Transfer pricing applies to capital gains taxes. So if you have a sale of a capital assets between connected parties, then the TP law kicks in, right? FRS or the state's revenue authorities are also allowed to disregard certain transactions and focus on a single set of transactions where there seems to be comprising, where there's supposed to be multiple transactions. And I think these provisions really are anti-avoidance provisions. So if you're familiar with tax plannings or anti-avoidance rules, what taxpayers will typically do, right, are to include layers and layers and layers of transaction of things that would not necessarily make sense, right? So the Act is telling us that for those types of transactions that are multiple or are convoluted or involve various steps, the revenue is allowed to disregard steps and just apply or just focus on a single transaction. Now, we'll speak a bit on computation of the taxes, but we won't go into detail because this is the forte of the accountants and the likes. Right now, if you remember, I gave an example, right? So the tax base for the capital gains tax is the profit you make or the gain you make on the sale of an asset, right? Now, You start from there in computing your assets. When you want to compute the tax, what are you allowed to deduct? So allowable deductions would include the cost of acquiring the assets, expenses incurred in enhancing the value of the assets, expenses incurred in defending or preserving. So for example, you have an IP, right? And you've expended money and time, you've developed your IP, your goodwill, or whatever, maybe trademark or patent, you've developed it, you've had costs to go to court to defend it against infringements. All the costs you've incurred at that point, right? You are allowed to deduct it when you're computing your taxes, right? And any other allowances. However, there are also deductions that are not allowable, premiums and expenses that are not deductible under other acts. Otherwise, there will be double deductions. Now, the Act also allows for exemptions, reliefs, and rollover reliefs. Capital gains tax does not apply to everyone. If you look at the law, there's a category of persons that are exempt. And if you go through the list, one thing jumps up clearly. Usually statutory bodies are exempt from the tax. So things like statutory or friendly society, cooperative, trade union, local government council, etc. Those government arms or government agencies are exempt. Now, the first one says an ecclesiastical, charitable, or educational institution of a public character. Now, this term has been litigated on in a couple of cases. I think a couple of schools against FIRS on the definition of what is an institution of a public character. If your company or if your client falls under the definition, I think the cases are AIS against FIRS and BCIE, which is American National School, beg your pardon. Those cases define what's an institution of a public character. The point to note, anyway, on this slide is not all bodies are exempt, are subject to the taxes. Some bodies are exempt. If you're classical church activities, charities, educational schools, generally, you'll be exempt. If you are trade unions, you'll be exempt. Local government councils and generally agencies of government are not subject to capital gains tax. Now, remember I said the trigger to Capital Gains Tax Act is a disposal of an asset, right? Once you dispose an asset, there is a chargeable gain or it's a chargeable event. However, there are exceptions to that rule. One of the major exceptions is disposal of a main residence. So the house you live in, for example, if you sell your main residence, then you don't pay tax on that. So even if you make a profit, even if you make a gain, those gains are exempt from CGT. Land compulsorily acquired, we've said that before. If a government acquires your land or an asset compulsorily, if your sale was not voluntary, if the capital sum you received was not received by way of you advertising the land, then you would not pay the tax on that gain. Or if you receive a gift and you sell that gift, whatever gain you receive is not subject to capital gains tax. Compensation or damages for wrong or injury, so personal injuries specifically. So if you're injured at work or you suffer an injury in the course of your work and you get paid a lump sum by virtue of your contract or damages by virtue of a court judgment, those taxes or those gains are not subject to taxes. So that's the list. I won't run through all. But just to show you that the Capital Gains Tax Act, as much as it imposes, it also takes out, which is why it's one of those reasons why the Act is not really one where a lot of focus is placed on. Still on reliefs. Taxpayers can get double tax relief, right, for capital gains tax suffered in other countries. But this would only apply really if Nigeria has a double tax treaty with the country that has imposed the capital gains on the Nigerian taxpayer. Now, the last I checked of the double tax treaties Nigeria has with other countries is 15, either 15 or 16. I think 15, the one with Italy that covers just shipping and transport. But generally, and this is where we can do more as a government, right? The government needs to think of expanding our treaty network. On the average, most countries have 50 plus, 30 plus upwards, but we have just 15. So it's a thing to note. This will not provide a lot of relief for people because, again, Nigeria's treaty network is very, very limited. And there's something called delayed remittance relief, right? When a taxpayer who is Nigerian residents disposes of an asset outside Nigeria, a disposal has occurred, right, in Nigeria, or for the purpose of the tax in Nigeria. So a charitable event has taken place. So tax should be paid, right? But the rule is that you only pay tax when you receive the proceeds of the sale in Nigeria. So as long as those proceeds are not brought into Nigeria or received in Nigeria, then you have like a suspended taxes. You can't be fined. You can't be subject to penalties. You're in a good place. But as long as you remit the monies back into Nigeria, then a taxable event kicks in, and then you are required to remit the taxes to the government. So for delayed remittance relief, right? If a taxpayer can claim that he cannot transfer the funds to Nigeria, this was not due to his own ability, but the inability of the law of that country, then there's a suspension on compliance with taxes. Rollover relief is something you may have already encountered in your previous classes. Essentially, rollover relief means reinvestment. So if you make a charitable gain on an asset you sell, right? If you reinvest the proceeds of the gain back in the business within a 12-month period, right, then you don't pay capital gains tax. So it's one of the ways that the government, again, tries to encourage people to reinvest in or to use capital proceeds for the purpose of running businesses. Excuse me. So the capital gains tax has something called rollover relief, which I just explained. And the rollover relief applies where the proceeds are reinvested in the same asset class that was sold. Now, some of the asset classes that we have in the Act are lands, buildings, machineries, goodwill, ships, aircraft. So for planning purposes, again, if you want to suspend payment of taxes, you reinvest to the extent that you reinvest, you get a relief for the portions of proceeds that you invested back in the business. Now, with respect to employment income, this law changed recently. Generally, right, any compensation for loss of office is exempt from taxes. Now, in 2021, the government changed the law to say any excess of a 10 million compensation would be subject to tax. I remember very clearly when this law was introduced, there was some confusion. And the confusion was, is it the excess of 10 million that will be subject to tax? Or is it that you are exempt from taxes if you earn 10 million, right? But more, like, I mean, the point is this, because the way the law was worded initially was subject to two interpretations. One school of thought says, oh, if I earn 10 million by way of compensation for loss of office, I'm exempt from tax, which is all well and good. Now the question is, if you earn 11 million, what is subject to tax? Is it the excess of the 1 million, or is it the entire 11 million that will be subject to tax? There was a back and forth with the drafting committee at the point, so this law was now rewritten. So it's clear now, right? The first 10 million you receive would be exempt, right? Any excess above that 10 million is now subject to Capital Gains Tax Act. So there's no more confusion as to say, oh, is this when I receive 11 million, for example, then the entire compensation for loss of office becomes taxable? No, that's not the case. The case is any excess above 10 million naira by way of compensation for loss of office is what is subject to capital gains tax. And what about employee share option plans, taxes due on foreign assets, right? So the law is clear again. With respect to employee share option plans, I mean, some companies have employee share option plans where options are granted to staff, right, to exercise shares at a future date, or exercise an option to buy shares at a future date. In many instances, the shares appreciate during the vesting period. So there's always usually a gain, right? So for the purposes of computing what the gain is for ESOPs, right, the law says they look at the fair market value at the day of disposal. That's when you sell your shares, less the rates, less the market value on the vesting date, right? So it's simple. Just look at what the fair market value of the price of shares at the day of disposal, fair market value price at the vesting period. Then the difference is the gain for those purposes. Now, Nigerians who sell shares abroad are subject to taxes, right? But the taxes are only due when the proceeds are remitted back to Nigeria. As long as the proceeds are kept out of Nigeria, then there's no taxes and you've not run foul of the law. In recent times, and I think it was just 1st of September that the Finance Act 2023 kicked in or was commenced. There are 3 new additions or 3 new amendments to the capital gains tax, and I've alluded to some of these in the course of the presentation. The first is digital assets. This is not surprising because when you read the Capital Gains Tax Act, right, the focus being that it's on intangibles, it sort of tells you quickly that any assets that is digital would be subject to tax. But we think the government just introduced this just for the sake of emphasis. The law on its own, without including this, would show clearly that such intangible assets are chargeable to tax. Now, one of the new introductions or inclusions in the acts are deductions. Before now, I think it was Section 5. Section 5 of the CGC did not allow taxpayers take losses as deductions or deduct their losses for any when committing capital gains tax. But now, what the law has done now is say, if you've suffered a loss, right, on a sale of the capital assets, right, or intangible assets, you can carry your loss forward 5 years. So I buy an asset today, 100. I sell it as a loss for 50. I'll be cured a loss on that asset. Now that 50, I can claim it back in future up to 5 years on any other capital gains tax liabilities I'll have in future. This is a new provision. It was never there before. In fact, this loss deduction was expressly prohibited in the capital gains tax just until last year, Finance Act 2023. The rollover relief for shares, nothing so different from what we said. If you sell shares, right, above 100 million, you are subject to capital gains tax. However, if you reinvest the proceeds, right, in a Nigerian company or in the same company, then the chargeable event is sort of wiped away. So it goes back to square one, no taxes on that basis. Now, I think we've gone through the framework of the tax, the administration, the new provisions, the specific provisions with respect to shares, definition of terms, and now we've arrived at the case study. I'll take a pause now and I'll go through the question to see, I'll go through the comments to see if there are any questions before we say we'll have a look at the case studies. Okay, I'm going through some of the answers before. Bukola said CIT. Okay, good. Innocent says trading nature. Very good. Trading nature. Okay, nice. You guys were following. No, it's probably a trading nature. Blessing says that's trading nature. Great stuff. Yes, fantastic. So let's look at one or two. Let's look at one or two case studies that we can call it a day. I will share the slides with the faculty, and the faculty will ensure that everyone on this call gets the slides. If there are any questions, I can't see them. Now looking at your answers with FRS, the answers with respect to who has the powers to enforce capital gains tax on residents of the FCT. I see FRS from Blessing, Chinazo. I'm sorry, but the answer is FCT IRS. Yep. And that's for individuals. But for companies, you'll be right if it's FIRS. Great. Okay, let's look at one or two case studies, then we can call it a day. Again, being that today is Friday, I'm keen that I don't stay too long in the office myself. So there are no questions. I can't see any questions that we can attend to. So let's have a look at the case studies. Okay, case study 1. Okay, there are some hands. Let's see if we can take some hands.
Hello.
Yes, yes,
Jimmy.
yes.
I just think that, generally, because I saw a lot of questions, some of them not related exactly to the, I thought that the question you asked was, you made reference to issues of currency, one aboki who trades on dollars and all that, whether it is income tax or CGT, which one will apply. So I expect that is what you may have to explain now. Then the other question will be when you are done, we'll have to pick up the questions and then you start answering them.
Okay,
So because I
fine.
understand, I understand that you are trying to use after you illustrated, whether you're in trade or not. So they need to understand that not just that because currency is mentioned and all that. So that's the aspect I'm expecting you to explain to me.
Okay, good.
Yeah.
Okay, so I looked at the answer, right, from people, and most of them got it. I mean, I didn't see any wrong answer. But just for the purposes of explanation, yes. So there are 2 things that can happen, right? When a business is carrying out its core objectives, that's day-to-day trading, and that's very clear from. I mean, if I was going to review a company, right, the first point of call would be to look at the articles and memo. Now, what the articles say. Your articles would tell you what exactly a company was set up to do. Now, looking at the facts on ground, if a company is buying and selling, if an aboki is buying and selling currency, right, is what he does on a day-to-day business. It's what goes into his profit and loss account. It's what he does by way of a trade, right? So if you look at the case law defines trade. Right? And it says it's stuff that you do on a day-to-day basis. Now, in those circumstances, even though currency in the CGT says the sale of currency is subject to capital gains, remember, the focus of Capital Gains Tax Act is not on day-to-day trade. It's more of sale of capital assets. Now, if you're using dollars on a day-to-day basis to trade, it's not your capital. It's more of a revenue thing because what you sell today goes to your profit and loss. And you keep selling it. What you buy, you sell. And if you think about it, it's very close to what the rollover reliefs are. For capital gains tax, even when you sell shares and chargeable tax, if you reinvest those shares back, then automatically you've enjoyed an exemption, right? So income that you receive by way of day-to-day trading are not capital, right? They are more of a revenue nature. So to those people who answer to say, the aboki will be subject to tax under CIT, they are correct. Because again, it's day-to-day income. So whatever revenue they have is not a chargeable gain. On the other hand, if you don't sell dollars or pounds or foreign currency day-to-day, if it's not your day-to-day business, right? You have a stash, right? And in reality, this may apply to many of us who buy currency. Because it's not your day-to-day transaction. If you have Forex, you sell and you find out that you make a gain, then ideally, right, you should ask yourself, oh, is this gain a capital nature or of a trading nature? Now, if you don't trade in it on a day-to-day basis, then you can only fall under capital capital gain or chargeable gain, and then you should go and file. So I don't know if that's answered, Doctor.
Yeah, thank you. Let me just add one little thing. You answered it correctly. The basis that we need to understand for the application of the capital gain tax as against other forms of taxation like income tax is that you ask yourself, this thing I'm going to dispose, is it capital or not? To understand the capital and income analysis, you use the tree and fruit analysis, tree and fruit. Like I have a mango tree. I plant a lot of mango trees. Then once the mango yields, I will harvest the fruit and sell and make my money. So each time I harvest my fruit and sell, whatever I make out of that fruit sale then CIT, if I'm a company income tax will apply. If I'm an individual, personal income tax act will apply. Are you getting that? Now, if one day I say, you know what, I'm done with this mango, I need to sell these mango trees. The mango itself, the tree, are my capital. The moment I sell them, then CGT will apply. Or for instance, you have a restaurant, you have your spoons, you have your cutleries and all that. These are what you use in doing your business. But the money you make from selling the food, the SITA or PITA will apply. The moment you say, you know what, I'm going to sell this capital, so that is when CGT applies. And that is why under the income tax, either personal or SITA, in terms of deduction and unallowable deduction, you can't deduct the amount spent on capitals or so that's part of it. So the capital gains applies only when that tool or material you're using in running your business, by the time you dispose it off, then the capital gains will apply. But the one question I want to ask Akinla Folajemi to answer, you talked about currency, you talked about other forms of capital. Now, in an inflation period, because it assumes that all these things, the naira or whatever currency you're using is stable. Okay? Are you getting what I'm saying? So what is the effect, like in the issue of valuation, when it comes to time value of money and all that and disposal? Maybe let's assume that I got dollars and saved dollar. In the next 3 months, dollar has lost value and I have to sell against another currency. For instance, naira. Let's assume that naira is a foreign currency and all that. You know that 100,000 naira last 6 months is not the same 100,000 naira this month. So how does the law treat that?
That's an excellent question. I didn't consider it, but I see where you're coming from. And if I was a taxpayer going to court, I'll say I didn't make a gain again when I look at the time value of money.
Exactly.
Yeah, because
is there any law to back it up?
But the law is actually silent on it. The law doesn't say anything on it. But I think, and that's very interesting. I think the law, the way the law is written, it takes a position, right, that you made a gain, right, without giving reference to what that gain is, right?
The form
because there may be a loss.
Exactly.
Because in reality, there will be a loss. If you look at the trend,
exactly.
Yeah, look at the trend of say, okay, even though I've made 10,000 naira because I sell dollars, let's say I made 10,000. It may see it's a gain on paper, but the real value of money. So the question is it not looking at the what I mean? It's very easy to prove in court. Thinking about it, why? And I'll tell you why. I'll tell the judge.
The court will ask you, to what statutory provision or case law you have to support.
And I'll say it's very simple, doctor. It's very simple. I'll say to the court, right, this gain I made, right, if I take it to the market, right, if I take it to the market at the time I started my trade, this is what I could have bought for. This is what I could have bought. At today's value, it's very sure that I'll buy less. So in reality, in real economic terms, because the courts too will not close their eyes to the realities of economic conditions. In real terms, I actually suffered a loss because, again, yes, of the devaluation of the naira. And as a matter of fact, even I've never seen any case, right, where CGT is imposed on profits made from currency exchanges. Right, with respect to CIT, it's a bit different because when there are foreign exchange differences, you can enjoy profit or loss and you tax it. But because that's by virtue of your day-to-day trading, it's easier to get away with it as a tax authority. But for capital gains, I think there's scope to argue that if you look at what you said I've gained, in reality, it's paper gain, but the value of that money really is most likely a loss. But it's a very interesting question, and I think I'll look up more jurisprudence to see if cases have been argued in courts on that basis.
Okay. Folajimi, I want to ask, do you think the introduction or the amendment that now allow a party to set off the capital loss of the same assets
Yes.
Take care of this issue.
I was going to say that too.
Issue that Doctor just raised.
I was going to say that too, that in computing your capital gains, right, it's not just the gain you look at. So you look at your expenses and the costs of that asset. So I can say, oh, doctor, it costs me XY to sell this money. And that cost would be the value that I lost, or would be the difference in the value of between now and then. So in computing capital gains, you start from the consideration, which is the gain. You take away deductions, you take away any losses and expenses before you arrive at what taxes you pay. Thank you.
Okay, thank you,
Stephen.
Jimmy. Can you go to the models?
Doctor, maybe even if you are to extend the analogy to normal property, I look at it in Nigeria as if you are just paying for the inflationary value, the inflation on assets, not even capital gain. Because in most cases, because of the inflation will also impact on the value of the assets. And you think there's actual value increase, but in essence, you may be paying the inflationary amount that have been added because of inflation. I don't know.
No, the problem with assets at the time you are disposing it, the market value will determine the market.
The market will determine the price.
So
exactly.
There's no problem there, So, but anyway, follow Jimmy. Can you go ahead with the model? Go ahead with your lecture so that we can round up and then start collecting the questions from our members, because there are a lot of questions that have not been answered.
What we have now is case studies, right? So
okay, case studies yes.
are questions. So let's take the questions, because I'm thinking that if we do case studies, right, we may answer some of them.
Let me go ahead and
yes, please go ahead
and read out the questions. Uchechi Anyanele asked, say, great session, Mr. Kinlaw. Please, what is the true difference between FIRS and FCT IRS?
So it's for administrative purposes, right? So FIRS takes care of federal, so taxation of companies and anything that is not an individual or a trust, or the FIRS to take care of it, right? So companies, taxes, FIRS would administer. Now, FCT IRS plays the same role LIRS would play in Abuja. So today, LIRS in Lagos enforces, administers taxes in relation to individuals, right, in Lagos State. And that's the same thing FCT IRS does. It administers, enforces taxes in relation to individuals who live in Abuja, FCT, right? So everything else with respect to companies nationwide is FIRS. Everything in relation to individuals in Abuja is FCT IRS. So they are two separate bodies. They are independent. When FCT IRS was set up, FIRS was supposed to provide some support to it. But I think they've grown, they've matured over last 3-4 years, and I think they're running their operations by themselves. There used to be, they used to share staff. I mean, some staff from FIRS were seconded, but they are two separate bodies. Just look at it as FCT IRS is like LIRS, responsible for individuals in the state.
Okay, if I may add, Fola Jimmy is correct. Historically, FIRS used to collect income tax for individuals resident in Abuja, in addition to the powers that they have under the law. But as from 2015, the National Assembly enacted the Federal Capital Territory Internal Revenue Service, which is, as Fola Jimmy has said, like the Lagos State Internal Board Revenue or any of the state board, because of course, FCT, FCT is administered like any other state. So the FCT IRS is now responsible for the collection of taxes payable by individuals resident in FCT. Thank you. So if you grab the Federal Capital Territory Internal Revenue Service Act 2015, that was when it was set up. Thank you. The next question is from an anonymous attendee. He said, how then is the money realized from compulsory acquisition tax? Or is it the case that it is not to be taxed in any event. You know, you mentioned about CGT
Yes.
and some of the exceptions when your property is acquired and all that. So you want to know how
Yes.
will the money realized from maybe compensation paid
So,
will it
so
be
for,
taxed?
yeah, so for compulsory acquisition, right, even though there's a disposal in law, that disposal, right, is not a chargeable event. So whatever compensation you receive for compulsory acquisition is not subject to tax. Right? It's a chargeable, it's a disposal, but it's one of the exemptions of a disposal. There's no taxable event. That disposal is not a taxable event.
That's correct. The next question is from FN Arinze. Arinze asks, he said, with respect to taxing disposal of shares, will it be exempted from CGT when the shares are sold involuntarily, compulsorily, or under distress?
And that's a good one, right? Because there was this case, and the case is actually on the slides. I didn't just lay emphasis on it. Where shares were voluntarily sold by a company. This was an old case in the 70s, right? And the question was there a disposal? So what had happened was the company voluntarily decided to liquidate, right? It sold the share. The shares were sold. The proceeds were given to the liquidator. The liquidator paid capital gains, right, on those shares, and then distributed the balance further down to shareholders. So the question was, those shareholders, what they received, was it subject to capital gains? Was there a disposal for them? Now, from looking at the facts of the case, because the liquidator paid CGT on the voluntary, on the price of the consideration received for the shares, which was a voluntary disposal, then that's fine by law, right? Well, with respect to the guys that that received the further distributions, the court said there was no disposal in that case. Now that's a slight extension, but when I look at the Capital Gains Tax Act, it suggests to me that a disposal must be voluntary, right? And possibly that's why it talks about compulsory acquisition of land. If you sell your property in circumstances that were not voluntary, then there's sort of a coerced disposal, which I don't think the law intends for you to be caught by. So to answer your question, Arize, with respect to taxing disposal of shares, yes, I think there'll be an exemption if you are forced to compulsorily sell, because don't forget that governments too, under indigenization decrees, they compulsorily acquired companies, right? In those instances, I don't know that the government paid, but if they had paid for those companies they compulsorily acquired under those policies of Obasanjo's first term in the 70s, would there have been a charitable event? I'll say no, because again, there was an involuntary or compulsory acquisition. I don't know if you have any further additions, Doctor.
No, thank you. I'm fine with your answer. That's fine. The next one, Mark Ikongbe. Mark stated that he asked, would costs of repair and maintenance of the asset be allowable deduction? Example, cost of repairs and maintenance of a generator set. What happens where the deductions exceed the gains? So in any case, there's a loss. Can the negative value be set off against other CGT that party is liable for? And you say other CGT, which means may not be the same class of asset, if I understand, right?
It must be the same class. So thank you. So Max, for me, I would look at the generator. Is it a capital asset? First things first. If it's capital assets and you've incurred money on the generator over time, right? Those fees or those expenses, you can take deductions for them. However, if you've taken those deductions under CIT, you cannot again take them under Capital Gains Tax Act. So you have to choose one, right? But because we are focusing on CGT now, I'll take it that the focus on CGT. So the question is it a capital asset? Yes. If you've expended money on it, can you take those deductions? Yes. If the deductions exceed the gains, Can you, is it, and there's a negative value, can you set off? Yes, you can set off, but you can only set off against assets of a similar class going forward, and you're capped at 5 years. You can't go beyond 5 years in setting off.
Thank you, Dr. Folajimi. That's fine. The next one, anonymous attendee. Which tax applies where the disposal of an asset is CGT exempt?
No tax. Tax must not necessarily be applied. If you not give you an exemption, enjoy your exemption and go.
I think he wants to pay tax by all means necessary.
I don't know why.
Okay, anonymous attendee. Good day and thanks for the presentation. Please, is the proceed of disposal of shares of a private limited company subject to CGT? If so, how would the price of the shares be valued or arrived at to determine the threshold for CGT? Thank you.
Yes, you'll be subject to tax if the proceeds exceed 100 million. Yes, and if you do not reinvest, yes, on one category. On second category, if you do not reinvest, right? If you do not reinvest the proceeds, which must exceed 100 million, right? Then you'll be subject to taxes, right? Now to the second leg, if so, how will the price of the share, fair market value, right? Or because a private company, I think the first thing to consider would be really what's the consideration for the sale of the shares, because again, it's not quoted publicly on the public exchange. So what did you receive? What's the consideration for the price of the shares? If it's less than 100 million, no tax. If it's above 100 million, yes, there's tax. If it's above 100 million, if you reinvest it, no tax.
Thank you.
Yes, sir.
Next question, anonymous attendee. Does the express inclusion of digital assets not mean that cryptocurrencies are now recognized as legal tradable assets in Nigeria?
That's a good one, because I know that the CBN has taken a different stance with cryptocurrencies or crypto assets. I know the CBN sometime, I think it was a couple of years ago, said they would not recognize it. So there needs to be an alignment between what the federal government is doing with respect to the Finance Act and what the CBN is doing, right? Whether I like it or not, crypto assets are alive and people trade on them. What I foresee may happen is you could have exchanges, right, for crypto assets that people can publicly trade, right? Now, currently, CBN would not recognize those ones, right? So if you trade on those ones, you probably be running foul of CBN law. But for tax purposes, if you trade on them and you make profits, you'll be subject to tax, right? If it's a private exchange or sale of cryptocurrencies, yes, because CBN is not looking at it, but you still make a profit, yes, you would be exposed to taxes. There's this jurisprudence between illegal activities and taxation. Now, Doctor, I'm sure you know more about this than me, but I mean, there are many tons of case law that says illegal activities can still be subject to taxes, right? I think it was it Escobar or one of the drug lords then, tons of cash for sale of cocaine or heroin, illegal activity, but then subject to taxes. So those two things are mutually exclusive. You can be carrying out an illegal activity and still be liable to taxes. Strange, but that's the reality of the law.
That's correct. That's correct. Follow me. The next question from Blessing Uchenna. Blessing asks, are gains exempted from CGT? Okay, are gains exempted from CGT subject to PITA, personal income tax? Example, compulsory acquisition of gains. Like those gains, if it is exempted in CGT, can it now be taxed under PITA? So that's the question.
So I know LRS. Thanks, Blessing. So I know LRS, right, in 2017 or so, issued a public notice saying that I think it was in relation to compensation for loss of office. which would have ordinarily been subject to tax under CGT, right, or loss of employment, Lagos State says they're going to impose tax on it. So compulsory acquisition gains, I mean, that's not really clear to me.
I doubt.
Okay. Yeah, I doubt it too. I doubt it too. So
I doubt.
Compulsory acquisition gains, if you are, that's for an individual, because you mentioned PIT. So no, I don't think so, because it's not
even under the personal income tax, compensation due to loss of office are not taxable either, except if there is any change. I'm not aware of any change against compensation for loss of office. So Lagos State Internal Revenue may be taking the wrong side of the law to insist that they were taxing.
That was 2017, yes. I think we challenged it there. But the point of this, Blessing, for compulsory gains, no tax under CGT, also no tax under PIT, because PIT really would look at things like your income and also trading receipts.
From trade or employment.
Exactly, if you're not employed.
They look at the receipts, the classification of the receipts.
Yeah.
So it doesn't fall under that. You're correct, sir. Another question from Chukwebuka Ibe. Chukwebuka asks, what is the practicability of collection of this capital gain tax? I mean, the law is there, how do you collect that? Looking at tax administration, compliance issues, collection issues, people are buying and selling properties every day, mostly in Lagos. So what is the mechanism of collection? I think it's a very important question.
Very valid question, Chibika. And that's why I said it at the beginning. If you don't agree, I said people don't really pay attention to capital gains tax. Even the revenue themselves, the tax authorities, they don't, because they feel like the cost of enforcing it is more expensive than what they will collect, right? So it's a good question you've asked. And that's why, again, I think that the Act focuses by default on intangibles. Because, I mean, some of the intangibles, they are high value. I mean, properties, if you look at property, buying and selling, we just said it. When you look at the cost of acquisition, the cost you've incurred in selling, and you compute, the gains may not be extraordinarily large, right? The capital sum may be large, but when you compute your expenses associated with that sale of that capital assets, you may find out that the what is left to charge to tax is sort of minute. So, but good question. There's a problem in administration because, again, capital gains tax is self-assessment. You need to file, prepare your statement yourself and sell. But again, the reality is this: the revenue does not pay attention to it because they think they don't get enough to put out themselves.
Thank you, Fola Jimmy. That's a nice one. Another anonymous attendee asked, is the CGT applicable to lawyers and law offices? Maybe lawyers and law offices have a special status, so let's know.
I mean, everybody is subject to CGT because you're not a law firm is not one of those bodies listed in the exempt bodies under the Act. I think it's section 30 or so. So yes, to the extent that the lawyer makes a chargeable gain, a lawyer may have, I mean, these days lawyers, we do all sorts of things. A lawyer may have valuable IP, valuable patents that they own, cryptocurrencies. Yes, law firms, yes. A law firm is a chargeable entity.
Okay, thank you. Bukola Abola asks, I saw that a lease or transfer of property is subject to CGT in the definition.
Yes, you're correct. So, I saw it too.
Okay. So maybe okay. So okay. Now
so transfer can be a sale. A lease too can be deemed a sale. For example, I mean, if you look at the head lessor in Lagos State, the government gives you 100 years of your lease. If you sell, so again, if you look at the Capital Gains Tax Act, it refers to rights and interests, right? So if you sell your rights and interest in land, a lease is a right or interest in land. So yes, it's subject to capital gains.
Correct. Then Ayotunde Ogundere asked, so where a taxpayer is not resident in Nigeria, but disposes of assets in Nigeria, is it chargeable to CGT?
So when I look at the law, right, the only instance would be with respect to ships that are not involved in international traffic, right? If you are not resident in Nigeria, ordinarily you should not, and you dispose of an asset, ordinarily you should not be chargeable to tax in Nigeria. However, there's a provision in the law that talks of location of assets, which was why I stressed it. There will be instances, right, where because of the location of your assets, right, and where you are at a particular time, you may be subject to tax, and that's where you have double tax reliefs. So the question is, if I was going to answer it, the general rule is that you only pay tax where you're resident, right? But a specific case would be, a specific exemption would be for ships, aircrafts that are not moving around internationally, right? In extreme cases, yes, an aggressive revenue authority would subject you to tax, even though you're not resident, but because your asset is in Nigeria, right? Those sort of instances can happen. And I'll say explore double tax relief agreements if you have.
Well, I'll add yes, that it has to be taxed as long as the property you are disposing of is here. Even under personal, under income tax, whether personal or corporate, source principle. You know, when you derive income from Nigeria, you pay income tax there. And if there is a property situated in Nigeria, and you dispose it off, I believe there should be in position of a CGT.
Yeah,
on the property.
I don't disagree. I just think that if you read section 4 talks about assets outside Nigeria. So
he's talking about, I think that relates to Nigerian residents.
Nigerians.
So we're looking at a non-Nigerian resident who has an asset in Nigeria and had to dispose it off.
Sorry,
are you getting that?
Yeah, I might share my screen now, right?
Yeah, you can go ahead.
Okay,
let's look at it.
Let's look at it so that so 4 says assets outside Nigeria. Without prejudice to the foregoing provision of this act, as respects any charitable gains accruing in the year or later from the disposal of assets outside Nigeria. Or these are assets outside Nigeria, not in Nigeria. Okay.
Not in Nigeria.
Yeah.
So yeah, this relates to a Nigerian resident who has assets outside and had to dispose it off. So it is applicable. And
yeah, but there's also A1 that talks about when the disposal of the assets by the individual who is in Nigeria for some temporary purpose. But I've interacted with this provision before too, and it was a bit.
So it applies. It applies. So if you're in Nigeria temporarily, and in the process you acquire property, and decide
I remember very well. The conclusion was that this provision refers to Nigerians with assets abroad.
Yes.
The law did not specifically make any reference to the reverse. But again, because there's double tax treaties, I believe that there are instances where you'll be subject to tax in Nigeria, whether you can claim relief from your home country.
Yeah, look at it,
Dr. Jude.
4AI,
Yes.
4AI and 4AII. You know, yes. These are part of looking at the deemed residency. Even when you don't meet the deemed residency principle, you still have to pay. So you say, for where the disposal of assets is by individual who is in Nigeria for some temporal purposes only, and not with any view or intent to establish his residence.
But that means he's not a Nigerian resident.
Yes, he's not a Nigerian resident.
Yes, and the assets are outside Nigeria.
No, the outside. If the asset is outside Nigeria and they have not met the
residency test,
it doesn't apply.
Exactly, that's my point.
But I think her question relates to the property you have in Nigeria, and you don't reside in Nigeria, but the property is situated in Nigeria. The capital is situated in Nigeria. I get what I'm saying. If the capital is situated in Nigeria and you don't reside in Nigeria, and eventually decide to dispose it off, will Nigeria say because you don't stay in Nigeria, therefore we're not going to impose CGT? I can't hear you. You muted yourself.
Thank you. So where a taxpayer is not resident in Nigeria, right, but disposal of assets in Nigeria, is it chargeable to CGT? It was in the chat box. So I think a number of factors will come in. Again, because you're not resident in Nigeria, but you have assets that were sold in Nigeria. Number one, What's assets? What's the asset category? That's what I'll say. Because again, if you look at the CDT Act, it defines and it stresses location of assets. And I think that sort of tells us where you would look at an asset for location purposes. And that helps in defining where the asset was sold. So if the asset was in Nigeria, by your question, I'm not resident in Nigeria. I don't think it's as straightforward as that, Dr. Jude. Because I'll look at
the point is that there is no way Nigeria or any country will allow you to go away with the income without being taxed. Either it is treated as a capital or it's treated as income. And if it is treated as income, on the principle of source, derivation from Nigeria, definitely we are going to pay. And in that case, the FIRS for a non-resident will impose withholding tax. For individual, 5%, companies, 10%, and that will be the final tax. But to say that CGT and CIT will not any of the income tax, either personal or corporate, Nigeria, no country will allow that.
But what if the person is not tax resident in Nigeria?
Yeah, that's exactly the issue we're addressing. The issue we're addressing is that the person does not have residence and the person does not meet the deemed residency rule.
Yes.
Because what we're looking at, the section 4AII are talking about relating to, by mentioning the issue 183, exceeding 182 days or 183 day rule, you're looking at the issue of deemed residence.
Yes.
So if you're a resident, that's no problem. But when you're a non-resident and you have an asset here, I believe the tax authority will definitely not allow you to go with the money without imposing either CGT or PITA or CETA.
Okay, let me answer it this way.
If you're from a country with a treaty, that's a treaty obligation to Nigeria, then the tax treaty, the DTT will apply
exactly
how much you're going to pay.
So let's look at it this way, right? To answer your question, Ayatunde, if I'll look at two things. The first thing I'll look at is there a tax treaty between Nigeria and the country of residence of this fellow? If there's a tax treaty, then you look at what the treaty provision says with respect to taxation of capital gains, right? Now, the treaty may talk about days of residency. Now, if you run foul of those days of residency and you're deemed to be resident in Nigeria, then you more likely pay the taxes. Also, because there's a double tax treaty will ensure that you're taxed in only one country. Both countries will not tax you. If you're taxed in country A, you can get relief from your home country, right? So if there's a double tax treaty, it's easier to answer to say the taxpayer will not be in a worse off situation, right? If there's no treaty, then it leaves room for debate between like what Dr. and I are debating on that. Okay, would it depend on the class? But I respect and understand your view. There's the inclination to tax it because again, it's an asset sold in Nigeria. But I don't know if we can totally exclude or ignore the residency rule in that respect. Again, because of income tax.
Thank you, Dr. Folajimi. An anonymous attendee asked, does the new Finance Act 2023 make subject gains on crypto to tax? I can't understand. Do you understand what?
I think so. I mean, the new Finance Act has included digital assets, right, as a category of chargeable assets. So that tells us that now, if you have digital assets, which a crypto would be one of those classifications or categories of digital assets, if you have those, it's now become a chargeable assets. So if you make gains on sale of those, then you'll be subject to taxes. But I think, again, you'd have to apply the trading and capital rule. If you're trading assets on a day-to-day basis, I mean, the question is that capital or revenue? The receipt you get from is capital revenue, right? That'll be my response. It's a chargeable asset, but how are you using it? Are you using it as capital or are you using it to trade? If you're trading with it, then no CGT. If it's a capital asset, if you hold it as capital, like shares, then yes, you'll be subject to CGT.
Thank you, Folajimi. The next question is from a big combo Akuro. he or she asks, I am a Bikuro, please. My question is on whether a property that is being sold for the first time, should it attract capital gain tax?
What do you mean for the first time? I mean, yes, it will. I mean, if it's the only exemptions I see for properties, right, is if you receive a property by way of a gift. So you get a gift and then you dispose it, no CGT. But if you've acquired a capital asset, right, and you sell it for gain, right, when you do your when you sell it for gain, then you are subject to taxes, to CGT. Now, when you compute it, you take out your expenses, what you've incurred, maintain the assets. At the end of the day, you may find out that there's no gain. When you do your deductions, what is left may be. Yeah,
Thank you for
that'll be my response. Yeah.
Thank you. The next question, I think you've answered this question in the course of this.
Yes.
Ayotundo Gundari say, will shares disposed compulsory or involuntarily be subject to CGT? Folajima has answered this question, yes. The answer is yes. No.
No, the answer is no.
Yeah, the answer is no. Bukola Bola, I saw that list. I think you've answered this question.
Answered this one too. Okay, I think we went up. Okay.
I went up, right? Oh, yeah. I think I went up. Sorry. The next one is what manner of forceful acquisition qualify for capital gain tax exemption? Is it government acquisition only?
Well, when I read it, it suggests government acquisition because it talks about the acquiring body is vested by law to acquire, and it also specifically refers to land, and it says if the authority has powers to acquire by virtue of the Land Use Act. So it suggests to me that it will be acquisition by a government body, and that government body must have the power or right to acquire, or to acquire from you. And then there's also a third leg. You must not have previously advertised that property for sale, because then it's no longer compulsory because you've put it up for sale.
Thank you. Next question from anonymous attendee. Will it be right to say that real estate companies who are in the usual business of acquiring, developing, and or disposing real properties are subject to pay CGT on the gains from disposal and not CIT? I think he has already answered this, but you can go ahead and put more light on that, throw more light on that.
No, for me, the question suggests to be a trade. I mean, if it's a business, buying and selling, then it's a trade, then it's CIT.
That's correct. Hajara Magachi, is there a room for Nigeria charging CGT where a subsidiary of a foreign company sells assets located in Nigeria and no tax treaty exists between Nigeria and the country of residence of the foreign company?
Is there a room for Nigeria charging CGT where a subsidiary of a foreign country sells assets located in Nigeria and no CGT? So what assets? Where is subsidiary located? I mean, in the country of residence.
I think the issue should be what are the personalities? I mean, the subsidiary is a legal person on its own. So if you dispose of any capital asset, you'll be subject to it.
CGT. Yeah.
Then Suleiman Alamo Yakin Tadese, sorry if I don't pronounce your name correctly, asked, are there exemptions from personal income tax? And what are they? Well, this class is for capital gain tax.
Suleiman, where have you been? Well, the principle is, I mean, because the law will not encourage double taxes, right? For example, PIT talks of, I mean, there's similar things. Again, like what I mentioned about, was it share options or loss of employment? FRS was trying to tax it. The point is that if you're subject to tax under one act, then you're most likely not subject to tax on other acts. So that's the principle. So, but this is CGT class.
On the same income.
On the same income, yes. On the same, yes.
So Obi Anonye now asks, if I sell a Bitcoin and receive another type of cryptocurrency, in what currency will I pay the resultant CGT, since the CBN does not allow cryptocurrency, while FRS wants tax paid in the currency of transaction?
First things first. This guy is very industrious. So,
Yeah, he's a very smart one.
yeah, but one question for me though. Sorry, hold on, please.
I think our time will almost. So if you can answer this and we'll ask one more, then we can call it a day.
I think I've run out of time because I just got a call to be at a meeting.
Okay.
Sorry. So
Okay, this could be your last question. Once you answer this one, then we can close it.
Yes, please. So my understanding is FRS, have they not removed that restriction on paying the currency of transaction? I thought I saw a circular to that effect, saying the taxpayer could pay in any currency they wanted to pay in.
I'm not aware. I think if your transaction is in dollars, would FRS want you to pay in naira?
Yeah, I think
I'm not aware of the circular.
Okay, let me know.
Maybe
I'll check again.
you may be correct, but I'm not aware of it.
Yeah, I saw something to that effect. But let me come back to you. But Obi, the short answer would be you will still pay taxes. FRS would so you're saying, so there's a principle in the CDT Act that talks about market value, right? So what I think would happen practically is FRS would look at the cryptocurrency you've sold, what you've made by the exchange, and attribute what the value of that currency would be. So what the value of that exchange would be. Now, cryptocurrency is not recognized in Nigeria's currency. What the Act talks about is digital assets. Now, because it's not recognized as a currency, you cannot pay tax in that currency because it's not a recognized legal tender. So FRS practically would look at value of the exchange and impute into naira, or because it's not even naira, and ask you to pay. But if the underlying transactions were in dollars, or the underlying value is in dollars, you could be asked to pay in dollars. I mean, if I was going to be aggressive as a tax authority and I look at the value of your currencies and what you've made and is pegged to dollars, I could require you to pay. So your question really doesn't have any answer in that sense. It depends on a couple of factors.
Thank you so much. Thank you, Follow Jimmy Akinlaw. You really enlightened us in this subject area. And we thank the members, those who attended this program.
Yes, it was very engaging. Thank you, guys.
Very engaging, very engaging, very engaging. So, Follow Jimmy, we're going to share at the end of the tax class by next week. We will distribute all the tax, all the lectures, all the slides.
Okay.
Follow Jimmy, thank you so much. Thank you once again. We appreciate it.
My pleasure. Always happy to
thank you so much.
Yeah. Okay. Have a nice day, guys.
Thank you, everyone. We're going to call it a day today. Please remember that we'll have our class continues the next Monday. Thank you. Bye-bye.